Welcome to this video where I'm going to take just a little bit of time to explain the difference between revenue, profit, and cash. They are all needed to operate a healthy business, but they are very different numbers and tell very different stories about your operations. In the perfect world, your revenue, profit, and cash will all grow at the same rate. But unfortunately, it's very common for businesses to generate a 25% increase in revenue, but profit remains flat and cash disappears. This is what I refer to as the busy but broke syndrome. Everyone in your business is busy, but at the end of the month, you're left scratching your head wondering, why are you so busy, but there's nothing to show for it? The key is growing your revenue, profit, and cash all at the same time by understanding each one and how they all work together. So first, we're going to dive into revenue. Revenue is the money that your business earns from the sale of services. It's the total amount that you charge your customers. It's also referred to as sales, income, top line, and gross. It is the value generating activity that you provide as a service, and then the customer chooses you. They say, yes, here's my money. I want to buy the service from you. It is reported on the income statement or your profit and loss statement. So imagine that you've got 15 new customers and they all pay you $1,000 each. Your top line on your income statement named revenue, that is going to have $15,000 on that line item. That is adding up all of your customer invoices, the total amount of revenue that's going to show up on that income statement. Revenue measures the effectiveness of your company's ability to convert leads to sales. So when you spend money on marketing to generate those leads and then convert those to sales, it shows up on this revenue line, the top line on your income statement. And so this is just what an example could look like. It gets its name because top line, it is the first line that shows up on that report. And that leads us to another keyword, profit. Profit is the result of a basic math formula. It's simply revenue minus expenses. And it has a couple of nicknames too. It's net income, the bottom line. It shows up on your income statement, or maybe you call it the profit and loss statement. Profit simply measures the company's ability to sell services at a higher price than the actual cost to deliver those services or to operate that business. And so it's simply a math formula. Revenue minus expenses equals profit. So here's an example of an income statement all the way down at the bottom line, hence the name. So your report might show it up as the line might be named net income. That's also the profit line. And out of $778,000 of revenue up at the top, this company was able to generate a profit of $118,000. Next up is cash. Cash, there is nothing mysterious about this. This is the same thing as in your personal world. How much money is in the checking account? How much money is in your savings account? Add up all of those cash accounts. They show up on your balance sheet. And it represents the company's ability to keep more than it spends. It's really common to focus on generating revenue. Let's just grow revenue. Let's add more customers. But then profitability may not maintain. And then cash, we may not have as much cash in the bank. The key is keeping more money than we actually spend, because that makes it easy for you to pay your bills on time. So a healthy cash balance is a good indicator of whether the company is healthy or not, because they'll be able to pay their employees and their vendors on time. And so here's an example of a balance sheet. Your first line item is cash. So it might get just a little bit confusing because you've got two different statements, two different reports that you're looking at. The first one, we looked at our income statement and we had some numbers from it. And then we also have our balance sheet, our cash balance. And the easiest way to see why all these numbers, how they all tie together, is by adding a third report, the cash flow statement. So the first section, revenue, expenses, and profit, that comes from your income statement. It's simply the exact same numbers. You just pull those numbers from that report. The balance sheet section, that second section, that's a little bit more difficult because you're actually looking at the change in the accounts. But keep in mind, once your bookkeeper learns how to prepare this report for you, you'll be able to use it on a weekly basis, a monthly basis, an annual basis. It will also provide a great springboard for looking at your cash flow projections going forward. So this is a great report to invest some time in, because one of the last things you want to do is to generate $778,000 of revenue, but then only have $26,000 of cash to show for it. That's the last thing you want to do. So when you take the time to fully understand revenue, profit, and cash, you'll be able to figure out what can you do to increase that cash. When you look at this cash flow statement, one of the biggest numbers is the accounts receivable. Out of the revenue that you generated, $106,000 is still owed to the company from the customers. And so one of the first things we would want to do is go look at the accounts receivable report to see if any of our customers are past due, so we can convert that accounts receivable into cash. So the winning combination for revenue, profit, and cash is when we increase revenue, we want to maintain profitability, and we want to make sure our cash increases as well. And so if you're running into a problem where maybe your revenue increased but your profit decreased, check out the number of discounts, the amount of discounts that your sales department is giving. That erodes profitability a lot. Also, look at your labor expense. It's very common when revenue increases, we might not have the processes and the systems in place to make sure that we're being very efficient in delivering that service. Or your labor force just might be tired. They might be overworked. They might need a break. And so they're taking 10 hours on a job that you've only budgeted 6 hours. And if it happens once, that's okay. Your profit can absorb it. But if it becomes a reoccurring event, then that's going to become a problem. Also check to see if your cost to acquire new customers, that marketing dollars, if that's gone up, then that could be a problem as well, because that means that your overhead has grown, but your revenue may not have kept pace with it. If your revenue and your profit have increased, but your cash decreased, you'll want to check your accounts receivable report and look to see how many of your customers are past due. If you do have a lot of them that are past due, consider changing your accounts receivable processes for your new customers. Ask for a down payment. Maybe only give accounts receivable terms to your really good long-term customers. But go ahead and pick up the phone, call those past due customers. This is not something that you need to delegate to someone else. Once it's past that 30 days and you're in a cash crunch, you need to be the one, dive in the deep end, pick up that phone and call those customers. Also, if your revenue and profit increased but cash decreased, you might want to look at those other assets. Maybe you've got too much money tied up in inventory. Maybe you spent that money on buying a new vehicle, which that's actually a good thing. That's actually a good explanation of why your cash decreased, because adding another vehicle, another work truck on the road, that's going to help you generate more revenue. And then also check out your loan payments. When you pay your monthly loan payment, there's a portion that's interest expense and another portion that is the actual principal. The interest expense shows up in your profit. It's an actual expense that shows up on the income statement, but the actual principal payment, that shows up on your balance sheet. And so it's showing up as a negative in your cash, and it also reduced your liabilities. So both of those sides of the equation show up on your balance sheet. That's why you might have less cash as well, because what if you decided to accelerate your loan payments and reduce that debt? That would be a great example of explanation of why your cash is lower than you expected. But the key is to really take the time to understand why they are not all moving in the right direction. Ideally, in the perfect world, you want to see revenue increase, profit increase, cash increase. Nothing in your business happens by accident. It's really fun to watch your revenue increase, but it takes all three of these: revenue, profit, and cash to grow a financially strong business. Thank you so much for watching. I look forward to seeing you at the top.